How's it going? I'm Barnett, financial advisor, Wiser Wealth Management. Just going to take some time today to discuss tax-efficient withdrawal strategies in retirement. Obviously, there's a little difference during your accumulation phase, during your working years, and then in your decumulation phase during your retirement years. There's various ways that you can do different distribution strategies in retirement. Cover a few right now. A lot of what retirement planning is just tax-efficient withdrawals and trying to figure out the tax bracket and where it makes the most sense to withdraw from. There's various ways you can do this. There's RMDs eventually at age 72 from these pre-tax accounts. So sometimes what we'll look at, which we've discussed in the past, is doing Roth conversions. That's where you'll pay the taxes up front on some of the conversions from traditional over to Roth, but the whole purpose of that is to have tax-free assets in retirement as well as just a lower RMD. So that's something we could look at. You could also look at what's called qualified charitable distributions, which would be gifting your required minimum distributions to charity. So some look at the big age there would be 72, and they've discussed moving that up to 75. Within our financial plans, we're usually running the distribution strategies being from your taxable accounts first, so that'd be any after-tax brokerage type account, then your tax-deferred accounts like your IRAs, and then your Roth assets. That's kind of just the normal distribution spending order. However, each client's different based on their income for that year, and it's really just doing some tax analysis, trying to figure out what makes the most sense. Besides the RMDs and the Roth accounts, there's also other things you can look at with taxes, including your Medicare taxes. So at 65, you can go on Medicare. However, your Medicare Part B premiums and IRMA taxes are based on income. So while you're distributing income, whether it be through conversions or just additional withdrawals to live, you have to be cognizant of the fact that you could increase those Medicare thresholds for Part B and Part D. So that's just something to look at, as well as realizing that Social Security can be taxed as well. Anywhere above about $44,000 in provisional income, 85% of the Social Security benefit is taxable as well. So you just got to do some analysis to make sure that any decisions you're making in retirement with some withdrawals aren't increasing your Social Security taxation, isn't increasing your Medicare premiums, and just making sure overall that you're just tax aware from these withdrawal strategies. If you have any questions on this is what we're doing, a lot of retirement planning for our clients. But feel free to reach out to us or give us a call. Thank you.